All right, stock started the day, kind of how it finished the week last week on this tariff news with a significant move to the downside. Wasn't as bad as what we saw Sunday night, and similar to what we saw last Sunday night. What I always tell market scholars is that you can never trust extreme moves in the Sunday night after hours trading. Very illiquid market, very illiquid market. So anytime you get an extreme move, it almost always never holds. And that, I mean, of course it can. So it's nothing's 100% or 0%, but most of the time the market, once the volume kicks in at the market open, we usually tend to buy up that gap. And we did that last Monday. We did it again here, especially considering the news that we sold off on, as we saw, wasn't necessarily permanent. It was, obviously kind of a threat that put a lot of risk aversion into the markets over the weekend. But that threat was somewhat abated, at least halfway abated, over the course of the day today as the market opened. So as a result, we were down today, but we were up off of the open and way up off the lows of the day when we hit the lows early in the morning. So good response to the market. The market's got a lot of grit, perseverance. So it's the buy the dip mentality remains strong. We talk about that a lot, and that was the case today. So we'll talk about the likelihood of this moving on into more bullishness the rest of the week, similar to last week, and what patterns might support that. We'll take a look at what's driving the price action. Recent move, a big move in healthcare. So our trade idea is actually going to be in a healthcare stock that broke out Friday on earnings, and then built on that and actually turned what was a weak ending on Friday to a pretty strong ending today. So we'll talk about how to trade that. Let's go ahead and get started. Today is Monday, February the 3rd, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're following us on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades we've done in the past, see whether we should stay in them or get out of them or not. We also put on today's trade already before the market closed in that video. Come down to the bottom, click this heart, it opens up this tab, hit that like button there. Same thing here, click this thumbs up icon, it opens up this tab, hit that like button right there. Again, the more you do that, it helps get our content out to all of our followers on those platforms, how they're based off how they work. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we ultimately finished down Friday, but in gap down earlier today, and went lower after the open before rallying and then coming off of the highs by the end of the day. So as a result, we were down about 46 points. The intermediate line was also down today, but just barely down. You can see it's really slowing down. Still above its market sentiment line, even if it's below the 80th percentile. They're both falling, but again, falling very slowly. The near-term line for them, after an oversold momentum line, threatening to bring the near-term line also down to the reversal zone, which would not be a good thing. We bounced. The momentum line bounced because of the rally. The momentum intraday rally, the momentum line bounced. The near-term line stayed out of the reversal zone. They were both pretty low at the lows of the day today. So a nice little recovery now produces the possibility of a bullish near-term low point. So this near-term line has a chance, if the momentum line can continue on this upward trend. It hasn't been the case lately. It's up and down, up and down, up and down. But if it can continue like this and go all the way up into the reversal zone and bring the near-term line up above 40, and if not above 40 and either 50 or 60, then now we have a bullish near-term low point. So in fact, considering how the momentum line has bounced here, you kind of would expect that to be the case. Even with the ups and downs here lately of the momentum line, again, this pattern you would expect that the near-term line will bounce. The momentum line will continue to move higher. The momentum line will bounce. The near-term line will cross eventually back up above the 80th percentile as well, back above its intermediate line, and you're back to being bullish again. So obviously that would mean we're filling in this gap. We're staying above the moving average. We're back to probably a dark green shading and a green line at that point again. So we're still 0.5% above the moving average. So I think that that's still the play, even with the weakness that we've had in the last 2 days. As we saw, we talked about this on Friday a lot in our classes, that any idea or prospects of tariffs are meant to be short-lived. Like at some point in time, the markets will stop really caring about the talk of tariffs or the idea of them, because ultimately deals get made. That was the case the first go around, and obviously has been the case so far with multiple countries, including Mexico here this morning. And so the market ultimately shrugs it off, just like it shrugged off the DeepSeek news from last Monday, and we rallied up higher by the end of the day. Let's take a look at some of the other indexes. If you take a look at the NASDAQ 100, this has been our bigger driver. We're still below the moving average, but just barely. The intermediate line has turned higher, so we had dark green shading again, but it's still below market sentiment, so we're not out of the woods yet. The near-term line fell below intermediate, but again is set up for a bullish near-term low to develop here and bounce right back up above it. So because, again, this would be day 2 of the near-term line crossing below 60, and we're definitely not below 20, which is what you would need to be on day 2 to really be bearish. So I think we have a good chance of, again, continuing the same pattern that we saw last Monday, this Monday, going into the end of this week. Let's take a look at the Dow Jones, because that's been a lot more bullish, right? Remember, it had actually had clusters last week, overbought clusters at the beginning of the week here. There we go. Oops, try this again. Sorry, my computer's slow. There we go. So after getting clusters early last week, the intermediate line still well above it's falling, but it doesn't matter when you're above the 80th percentile. It's still way up there, still well above its market sentiment, which is now rising. The near-term line again falling below 60, below 40, avoiding going down, following the momentum line down, like it was set up to follow the momentum line lower into the reversal zone, but we didn't, right? So because of the strong rally off of the lows, the momentum line bounced up, the near-term line avoided, falling into the reversal zone, and again is set up for a bullish near-term bounce, depending upon how bullish and whether we end up closing the rest of the gap here tomorrow, which is again what you would expect based off of how the momentum and near-term lines finished. The Russell 2000 is a little different. The near-term line is below its intermediate line, which is actually still above its market sentiment, but it's still in neutral levels. The intermediate line and market sentiment line are both in neutral levels. The near-term line, however, formed a bearish peak. And we are, you can see you got the dark green shading. We are below a falling moving average. That's why it's red. Just barely below it, 0.06% below. And you can see the near-term line, again, it never crossed below 60 because we were never above it. So we're still on the same near-term decline. This wasn't enough of a rally to halt the same near-term decline that we're on. So again, we're not as bullish. We're not set up for the same kind of bullish bounce as we are on the other indexes. Because again, we didn't come down and fail to produce a bearish near-term low like the other ones did. So a little bit more weakness here, as again we are still unable to get up above the high point of that bear tag that we formed back in late January. All right, now let's take a look at the weekly chart and see how the weekly Hakinyashi candle is looking. We talked about, we were looking really good at the end of the week for a bullish candle, but because of the gap down, instead of forming a bullish candle to start off the week, we gapped down so much we ended up forming a bearish candle to start off the week. Now again, there's an upper shadow and a lower shadow, so it's technically still a transition candle. It's not too bearish, but we are flirting with closing below the 10-week moving average, flirting with it. We don't have the red arrow, otherwise, once we cross, we will get the red arrow there. So that's a bearish sign, relatively bearish sign that we get this lower close and then now a bearish body. Now again, it's a small bearish body, and like I said, it's more of a transition than a bearish candle. So we have to see how we play it. It's only one day of the week, so I'm assuming if we end up with a rally throughout the week, which is what I'm expecting, that we'll end up with a transition candle again here, and then we'll just reverse back up to the upside is what my expectation would be. Obviously, we don't have 3 green arrows anymore. We have the 1 red arrow on the MACD. The Dow still has 3 green arrows, but the Russell 2000 actually has 3 red arrows. So that's going to be light pink shading tomorrow. The Qs have 2 red arrows because we're still below the moving average there as well. Only the stochastics is green. So we're not in that nice, good 3 green level right now, but we're not far away from getting back there. If we were to get a good couple of days here, we can easily get back there, fill in the rest of this gap. we finished in the upper half of the range, even if we haven't got a new high, which is now crossed below 70. But we're not necessarily yet. By the end of the week, the low point will be over here, barring a new low forming. And you remember that we don't have a big gap. We're above 5%, but that's a pretty small, relatively speaking, to where we've been. So, we're susceptible to a weakness here on the intraday chart, even if, again, if we can get a new high by the end of the week and get that green line back up above 100, back up to 100, we'll feel much better about things. Let's take a look at some of the other oscillators. So we'll look at the DMI pattern. You can see we're above 30 on the negative indicator because of how bearish we were. But because we moved higher throughout the day, the positive indicator actually stayed above 25. So they're both above 25. Again, it's rare for that to be the case, but as of right now, that's actually a good sign. We saw that over here as well. We ended up bouncing, so a good chance that can happen again. If you take a look at the RSI and the CCI, we are below 50, but not significantly below 50. So we'd have to halt because we actually dropped below 50 today. So we'd have to edit this and only go to yesterday. So it would actually be the 28th. Because then it would, we'd stop that and turn it red from today if we ultimately cross below 40. So kind of like what we saw right here. We go back to the point where it crossed below 50. But, again, that's not necessarily a threat, an imminent threat, because, again, the CCI didn't drop below minus 100, much less below minus 150 or minus 200. So we're okay. We're okay there on that. And then you look at the Ichimoku cloud. Again, no trend, not even on the bearish side of things. We're still above the cloud. The cloud's still green. We're still above the blue line at least. We still have a positive rate of change. So everything is still fine for now. I showed you the intraday chart, the volume. The trading range today was large, especially when you include the gap. Even without the gap, it was above average. Including the gap which is not very much of a gap, 601.82 to 621. So you're looking about 1.5 points extra to add on to that. So still a pretty decent range and above average volume. Again, not the things you want to see. You want to see these two lines falling, not rising. It looks like they're both turning up. But if we get back above the moving averages, then we'll get smaller ranges again. We'll get back to below that 1%, which is where we really want to get to, and everything would be fine at that point. The VIX started off the day up, which is not surprising. Came down throughout the day, finished below 95%, so still at the upper end of neutral territory, but still in neutral territory. The VVIX, however, stayed up high too. So here we are, 109. The VIX ultimately went up 13%, but the VVIX, you can see that closing there 110 just shows that there's still a lot of concern, even with the market rallying off the lows today. The volatility dropping. There's still a lot of potential energy. There's still a lot of pent up concern about where the VIX could go from here, especially with it crossing up above its 200-day moving average, which is generally a bearish sign for risk appetite when the VIX itself is above its 200-day moving average, especially when it gets above that 95% mark on the VIX to VIX 3M ratio. All right, now let's talk about what's driving the price action. You can see over the last 3 months continues to be a big, strong return on the Qs relative to other equity areas in the markets, international, developed and emerging, as well as small cap stocks here. But let's just look at what happened here today, especially on the open and then after the open. So we'll go to March the 3rd, or February the 3rd. You can see we started off with every single safety trade doing higher, like even foreign bonds were up, treasuries were up higher, which means yields were lower. Gold was up, gold and the dollar and yields were all up together, which that's the ultimate safety trade. Commodities are up too, which is kind of when those are all three up and commodities are up too. Commodities obviously tend to be associated with risk appetite because they fuel a growing economy on the one hand. On the other hand, commodities are physical, tangible asset. So really risk off moves, they can also still move higher because they are because of the tangible aspects of it, especially in this case with crude oil, the move crude oil had in response to the tariffs on oil from Canada going into the U.S. Obviously, small cap stocks and U.S. stocks in general just started off the day bad, down 2%, 2.5% for small caps. Small caps still finished the day lower than 1%. The Qs finished lower than 0.75%, but well off their lows of the day. And you can see, but well off their highs of the day early, like in the afternoon. But, at the afternoon, you're going into that last hour of trading. And we were only down 1/3% on the Nasdaq, and we were only down less than about 0.75% on the Russell 2000. Excuse me. And then you can see the late sell-off. Again, not just in U.S. equities either, international equities. All really struggling today. Of course, the big news was the tariff news and the impact that had on currencies. Let's look at how currencies moved today, especially like the Mexican peso and the Canadian dollar. I'll bring up the today's move. Look at that move on the Mexican peso. So that's the U.S. dollar. That's the Mexican peso really taken off here. Excuse me, the Mexican peso really taken off against the greenback. The Canadian dollar also, you can see there, also moving against the greenback. So if I showed you the actual currency pair, so here let me bring up U.S. dollar, Canadian dollar. You can see the big move that the U.S. dollar had against the Canadian dollar throughout the day. Big time rally on the Canadian dollar off of the open, right off of the open that when the dollar gapped up so much. And then you look at the Mexican peso and you see something very similar, right? It's rare to get an engulfing pattern on a currency. They're traded 24/7. The only time they're closed is when banks are closed, which is over the weekend. So you can get gaps on the weekend. They tend to be very minimal, but obviously not this weekend. There's enough news. They've created a significant move in currencies over the weekend, significant gap in currencies over the weekend. And again, with the move higher on the Mexican peso and the Canadian dollar throughout the day today, significantly higher. In fact, even commodity currencies, the dollar really fell by the end of the day. If I were to take a look at the dollar index here, big time drop after the gap up to the upside. So now we're not out of the woods. We're not below moving averages. We're still above the short-term moving averages, even if we're slightly below the 30, like we were slightly above it on Friday. So we're not out of the woods. We need to see some follow-through on this. But you can see, again, where the market could be and wants to be in light of this news, based off where it traded last night and early on the session. So the bulls are out there for the dollar. The dollar bulls are clearly out there, and they didn't win the day today as the dollar bears came in and erased that move. But the bulls are still there, right? They're still out there. They were there today, and we'll see if they win the battles the rest of the week. Of course, a weakening dollar, generally speaking, as we saw today intraday, is generally good for risk appetite. And so, and that was the case here. If I take a look at the 10-year yield, let's take a look at the 10-year yield here. If it will come up for me. There we go. It's also, again, started the day down, rallied throughout the day, which is interesting because usually the dollar and yields move together. That wasn't the case today. The yields moved up throughout the day. It's not as much, but the dollar fell a lot throughout the day, and stocks rallied quite a bit throughout the day today too. So it continues to look like yields are holding some support here at the 50-day moving average and looking like they may turn around as that MACD and stochastics looks like they're turning up there. So that will have an impact. Again, it will be hard for the dollar to be too bearish if yields are rising. And really right now, considering yields are already over the Fed funds rate range of 4.25%, 4.5%, there's only one reason why yields would rise, is inflation expectations rising. No matter what, right? No matter whether you agree with tariffs or not, or whatever the reason, right? Whether even it's tariffs or not, inflation expectations in the market rise, and that's generally bullish for yields. And it's generally, like when yields are bullish, it's generally been bullish for the dollar lately during this inflationary environment that we've been in, and that's been bearish for equities in the past. Of course, the other thing to kind of keep an eye on, as we saw, is that also rallied today is crude oil, gold, and that had an interesting trade, especially relative to, we'll look at the futures contract, to Bitcoin. So you can see gold Started the day high, fell throughout the day, but finished the day at near its highs, near its open and near its highs. So a good rebound for gold intraday. But of course, Bitcoin and gold are supposed to be kind of similar in terms of safety trades. Bitcoin fell significantly throughout the day today, closing easily below its 50-day moving average, getting to 91,000 before finishing back up above 100,000, finishing back above its moving averages. In fact, finishing back above the 17-day moving average there. So a big rebound as well. But again, it goes to show that the Bitcoin bears are out there, and that's a perilous gap to fill between the 50 and 200 because there's not much volume here. Moved up so fast, there's not much volume to keep it, to slow it down. So an easy gap to fill if it starts to fill it. And you can see we've been converging here for a while, and it seems like it's not going to take too long before we start to fill that gap in with the MACD crossing below zero and the stochastics dropping in the bearish territory. So it's holding on for now, but we'll see which one wins out as a safety trade, right? Is it going to be an anti-dollar safety trade? Is it going to be gold or is it going to be Bitcoin? And if the dollar continues to rally along with yields, then neither one of them will, right? Neither one of them will win out, and they'll both be pressured by the strength in the dollar. Let's take a look at the breadth in the markets today, and that's also kind of a little bit of a red flag. As you can see, the breadth is starting to show some signs of weakness. The McClellan oscillator dropped below zero for the first day, so that puts the prospects of a Hindenburg omen on the table. We have to cross above 70 on both the new highs and the new lows at the both of them, and we did not get that on the new highs today. Got to 93. Let me update it and make sure those numbers are correct. 38. We got up to 38. Only 9. Like we were above it on the new lows, but not on the new highs. So no Hindenburg omen, but the breadth still is relatively weak. As you look at the number of stocks above the 50-day moving average, breaking back down below 250. Well, after breaking above 300 briefly, all the way back down already. The new highs and new lows. I showed you the new highs here. Breaking back down below its average, its 20-day average. So we had been, pretty strongly bullish here, but today's move down. Well, but remember, it's actually not even 74. It's actually at 38 when you look at just the NYSE. So and that's way down here. So big breakdown in breadth for the markets. And then if you look at this percentage, how many stocks above the 200 relative to the 50, we're not above the average here, which is bearish whenever you get above that average. But that was a pretty decent jump. We never did cross below 1, which is what you really want to do when you're bullish, is get below this average and stay below it, and ideally get below 1, right? Because then you can really take off. The lower you are, the higher it has to go once it turns up, and the more bullish you can be going forward. So, again, dropping down to 1.1, we've seen the last two times that it did that, and we only rallied just a little bit, right? Not very much at all as it rose up there. So that's the issue here. We prefer to drop a lot more off of these bounces so that we can rally more and be more bullish for an extended period of time before we start to run out of gas, right? Because again, once you get above that moving average and that moving average rises, that tends to be bearish for the markets. So the breadth is looking, it was looking pretty good and pretty solid, but it's starting to look less solid, and the money flow is still looking pretty decently strong. We had gotten up almost to the 8th percentile, and we're still easily above the 60th. But you can see the money flow index itself on an absolute basis is starting to drop down more than what we had seen, especially with the drop was relatively weak during this initial stage, but now we're getting more of a drop than what we had seen previously. So strength is picking up on the decline there. Let's take a look at how the sectors moved today. And of course, remember, the big one that we pay the most attention to is where the technology sector is trading. And obviously with Nvidia and Apple, it had a rough start to the day. It rallied and it finished only down 1 1/3% along with discretionary there with Tesla and Amazon. Industrials also managed to drop. Industrials do poorly in a tariff environment, so they fell below the S&P. You can see our big winners today was healthcare, staples, energy, utilities. I mean, these are all sectors that we don't want to outpace the markets, and we definitely don't want them to outpace XLK, because the more that they do, the less likely we are to be bullish, right? When you look at just XLK in general relative to the market, we're below its 17-day average. We're below the 50-day average on the ratio chart and falling. We're in the lagging category here on the relative strength and remaining in the lagging category. If I take a look here, let's take a look on this one. XLK relative to SPY, as I showed you, the ratio is below its 50-day average, well below the 200-day average. In fact, the 30 is about to cross below the 50. So pretty bearish perspective there. But if I look at XLK relative to, like, say, utilities, right, then that's a ratio we do not want to see any weakness in, because it tends to be very positively correlated with the markets. And you can see we have been breaking down below the 200-day moving average. And if I look at it on a little bit longer term, look on a weekly basis here, then you can see it's also rolling over below the 50, making its way down to the 200-week. Its correlation generally is very strongly positively correlated and has been negatively correlated lately, which tends to make for a bigger move, right? Usually when the correlations are weaker, you tend to, when they're positive but normally when they're negative but normally very positive, or vice versa, it tends to set up a move when it starts to correct. When it gets back to positive, which are they going to both go up? Are they going to both go down? And as of right now, you can see it looks like they would end up both going down. In this case, the ratio along with the S&P 500. So a very important ratio when you're looking at technology relative to safety, a sector that's more associated with safety, even energy, right, which is not necessarily associated with safety, but again, this is a ratio that's very positively correlated with the markets. And we are above the 200-day. We had a nice little rally and set off that 2023 low, but we've been converging, and the MACD histogram is rolling over, and we're definitely getting less strength there and more weakness starting to show up over the past few months. All right, and that brings us to our trade idea of the day. It's actually on AbbVie, so let's take a look at AbbVie here. Nice good breakout on Friday after earnings. But then today, gapping down like everything did, but just to a very small degree here, and still holding this old high that we had closed up above, and then really rallying, reversing the course, because we actually fell during the day after initially peaking and then falling and closing at a lower low than where we opened after the earnings. So good reversal today. Continuing to fill in this gap here from November. The intermediate line has crossed up above the 60th percentile in the bullish territory. The near-term line is still above it. Market sentiment still rising. Good, strong move. So a little different than this time, where the intermediate line also got in bullish territory, but we never really got above the moving average. This time we did, very similar to over here after earnings here, and we continue to move higher. If you take a look at the weekly chart, we actually just are getting a golden cross, a crossover of the 10-week moving average, crossing back up above the 40-week, so like a 5,200-day cross. You can see a nice, good bullish candle, big body, one of your bigger bodies that we've seen. Again, we didn't see that big of a body here. The last little weak bullish move, so a little different this go around. We obviously have 3 green arrows. The stock has 3 green arrows and a lot of volume. Yesterday has above average volume still today, so that's all good signs. We're closing above the 200-day moving average this time. Last time we failed at the 50. We got above the 200 but failed at the 50. Here we're crossing everything. The 8 and 17 are crossing the 30. We're above the point of control. We're above the value area of the past year. So really, really good breakout for AbbVie. If I take a look at now some of these other oscillators, they're all going to be showing breakout patterns here. We're still above 30 on the positive indicator, below 20 on the negative, so your ADX is rising. Very good bullish sign there. If I look at the RSI and the CCI, they both broke up to big, strong levels. Well above 60 on the RSI, above 200 on the CCI. If I take a look at the Ichimoku cloud, you can see we're above the cloud. The rate of change is strongly positive. The blue line, the green line, we're well above those. We have a weak bullish trend developing there on the indicators. Again, similar to what we saw over here on that breakout earlier. So I think we have an opportunity to take advantage of this, closing up above the upper band and the upper Keltner channel, with the bands moving outside the Keltner channels for the first day today. Momentum just barely turning positive. So what I decided to do is be a little directional on this trade. So we'll come over here and do a long call vertical spread, selling pretty much the only call. That one's a little too far away. This one is too close. So I'm going to do this one, buy the 195 for protection. This is what the trade looks like. If I position size, what I normally do for a directional trade, I get almost a 2-to-1 reward to risk ratio. Again, we've already done this trade in the Market Outlook Live, so we did get filled in there. And what, $1.76 for the cost of the trade. Hence the N3 contracts, and then getting almost about, again, like I said, a 2-to-1, almost a 2-to-1 reward to risk ratio if this works out. All right, well, that is it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody. We'll see you all tomorrow.